This is a discussion about Silicon Valley real estate market the week ending May the 2nd. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers in single agencies here in Silicon Valley, which is Alameda, Santa Clara, and San Mateo counties. These are the key chapters that you can jump to in the YouTube description below to get to the parts that you find most valuable for whatever it is that you're trying to do. I'm available for consultations. Let's move on and get into the data. This is looking at the number of sales that would have been accepted for Silicon Valley in the last week. Normally, I look at 5 weeks. What I'm trying to do is look at the impact from recent changes in the economy. Easter moves for a 5-week period of time between, I think it's March 22nd and April 25th. So now we're our second weekend past Easter, and you're starting to be back to where the data is reliable. Where you're seeing is you're below the least number of offers. You're essentially equal to the least number of offers you'd expect. You have to remember that includes 2020 with the pandemic. So the blue line is artificially low for a couple more weeks because of the low sales in 2020. Then sales in 2020 actually went up pretty high once we recovered. But anyway, this is what my point is the blue line is artificially low, and we're right at or slightly below the blue line. So we clearly have a lack of offers in Silicon Valley for the past week. And that's from Saturday morning of last week through Friday night, midnight yesterday. This is now looking at Santa Clara County. Santa Clara County is sort of right with Silicon Valley, slightly above, but I would call it right at the blue line. San Mateo County is way above. San Mateo County is almost normal. Gray line would be normal. Had a big dip down for Easter and then the recovery. So the number of offers for whatever reason in San Mateo County is not following the trend for Silicon Valley. And then we'll move on to Alameda County, and Alameda County is a little bit worse than Silicon Valley because remember, Silicon Valley was right up by the blue line. So you have 3 counties that make up Silicon Valley, and all 3 are doing something different with regards to the number of volume of sales. Alameda County is the most hit, followed by Santa Clara, with Santa Clara being sort of the typical, and San Mateo County is surprisingly almost unhit by the recent downturn in the number of offers. That brings us to our first data slide, which is a summary slide starting off with inventory. Inventory went from basically normal, 103% of normal 13 weeks ago. It's now up here, which is 3,100. So inventory is more than doubled, and it's also gained to about 138% of the inventory. So you've gained somewhere around 35% of your market share, a little bit more than a third more inventory than you expect. You can see you were basically at the typical gray line. You came up at a steeper rate. You hit the blue line. And then the last couple of weeks, we've gone significantly up above the blue line. We were basically above it. Then we had Easter, which is less inventory coming on the marketplace. And now post-Easter, we've come up and we've had 1-2 weeks post-Easter, and we've recovered that inventory. So we actually have a surplus now of 37% above where you'd expect it to be, 38%, which is a gain of about 33% in 1 quarter. Moving down to offers. These are offers that were accepted and have not failed that have occurred during the past 5 weeks. We were at 971, which is basically 80% of normal. You're now at 75%. So since the numbers are so close, let's go back and call this 79% to 76%. So a 3% drop in the level of offers accepted, even though the offers have more than doubled. We're at 2142. The least you'd expect is 1900. So we're above that, which is why you're above the blue line. But you are 25% below the 2832, which is the number you'd expect, which is why you're only 75% of the expected marketplace. Transactions just gives you an idea of how many closings have occurred in the past 5 weeks. Again, there's about a 4 to 6 week difference between offers accepted and transactions closed, but there's also an impact on transactions that fail. An offer could start off as an offer and count for a while and fail. It will never count even as a partial transaction closed. You went from 970, which is 68%, 2/3 of the normal level of closings that you'd expect, to 77%. So you've gained 9 percentage points at a time when your inventory has gone up by 35% and your number of offers have declined. So there's clearly a discrepancy between the rate of growth of inventory. Inventory is growing, water's coming into the reservoir quicker than it's going out through initially offers and then eventually closed transactions. So if this keeps happening, at some point you'll reach the spillover point of inventory, surplus inventory. And then the more important one is the supply-demand ratio. So this gives you an idea of the demand as well as the supply. We started off at 120%, 20% more than normal. We're now 2/3. So we were 1/5 more than normal. Now we're 2/3 more than normal. More than normal is a slower marketplace. But you might say, Richard, we went from 53 down to 51. How come the number's gone up? It's because the normal number, the gray line, dips down. So it's a percentage of this gray line. So normally you'd be down here at 30 days, 31 days, and instead you're up at 51 days. So you have 20 more days. If I did my math quickly in my head, you're normally somewhere around 44 days back here, and you have 8 days more than that, which is how you get 53. You've gone from somewhere number around 44 expected to a number of 30, so it's decreasing. Or, the slowest you'd expect the market to be is 43, and yet you're at 51. So you're a whole week longer than the slowest you'd expect. In other words, the blue line is 7 days lower than the purple current data line. Then the time to sell 75% of the marketplace, you can just see how rapidly this changes. You started off here on a typical line, and yet you were way down here. So just 13 weeks ago, we were absolutely on fire. The market was selling quicker than you'd expect it to be. The market has, the speed of this current year's marketplace has been basically flat. So that means it caught up to the red line, then the gray line caught up to it, and then the blue line caught up to it because it's been increasing slightly for the last 5 weeks, which is helping it cross over all the lines. And you're now above or taking longer to sell than you expect, but you're only at 21 days. So don't get me wrong, 21 days is still fairly good. Most sellers would be happy to sell their property in 3 weeks anywhere in the country. It's just we're typically at 2 weeks. We're at 15 days. So again, you're 6 days longer than your typical, and 15 to 21 is a fairly significant change in the marketplace. It's 40% slower than you expect. The fastest we get is 12, so you typically don't get very much faster, but then there is no upper limit on the slowness, but the slowest that you would expect is 18 for this time of the year. And you can see for the foreseeable time frame, it goes up slightly, but not up significantly. So you're clearly having a longer than typical marketing time, although still reasonably fast. Now look at seller's ask price. This is, in my opinion, really seller's expectations compared to the market reality. Beginning part of the quarter, we were between taking less price reductions, or sellers were taking less price reductions than typical, which means their expectations were in line with the marketplace. Then about 10 weeks ago, they started taking right at the typical number of price reductions. Then it became more. Then it got down to the cool marketplace, which is more than you'd expect. And now it's pulling away. And so now you're at 309%. So 3 times the price reductions. And this is magnitude. Now the magnitude is still very small. It's only 1%, but it's 1% of only 15% of the marketplace. So that 15% of the sellers that are taking that 1% are taking like a 7% price reduction. The key is this is a number that nobody has control on. If sellers that thought they understood the marketplace, they came on the marketplace, they weren't able to sell, and they had to lower their price, that number, that magnitude is increasing, and it's increasing fairly significantly. The least you'd expect is 7/10, 0.75%, and now you're at 1%. The typical of what you'd expect is that 0.3%, which is why 100.01%, just call it 1%, is 3 times the 33%, and that's how you get the 309. Basically, it's saying that the sellers have been more optimistic than the market's actually treated them. Then the overbidding was at 3.9%. You'd only expect it to be 2.8, so it was actually 1.1% more than you'd expect. And now, currently, you're at 7.4%, and you'd expect 7.3, so you're almost dead on. So you've now become less competitive, and you're basically typical. So you're right where you'd expect the market to be. Keep in mind that even in a slow marketplace, the least amount of overbidding we expect in Silicon Valley, based on the previous 10 years, is 4.8%, almost 5% overbidding. Silicon Valley is a marketplace all to itself. Here's looking at the three key indicators over time. So now what you're looking at is inventory in the purple. And you can see we went from at the beginning of January, so just at New Year's, we were about 73% of the typical inventory. We've gone up here and we're now about 138% of the typical inventory. You can see the Easter blip on there, which is why it was so hard. And with Easter being the holiday that moves the most, I don't know of any other holiday that moves by 5 weeks. Most holidays only move by 1 week. It really impacts the data because you can see the impact on inventory here. Then moving on to offers accepted, you can see we were down at 70%, went all the way up to 90%, on the way to normal. Then we did a reversal and we went from 90% of the offers you would expect down to about 75%. So we're still better than the 68 that we were at in January, but we're still not at historical low levels, but we're getting close to some of the lowest levels. The only level that was really lower was basically early in 2023, right after the 2022 price correction. And then moving on to the last indicator is days unsold inventory. This is where we're in record territory. And based on my graph and my expectation, I probably will have to change the scale of this graph for next week. The only time that we were at this slow compared to normal would have been back here during COVID. And you can see even that period of time was very narrow. And that probably corresponds to the time when we couldn't even show houses. So the other normal, the peak normal time frame was then the slowdown in 2018, which was mostly impacted in Santa Clara County. Here's now looking at just active inventory. You can see the purple line has been going straight up. It was down here with less inventory than you'd expected in the beginning of New Year's. Got to typical for basically by Valentine's Day. And then it got to be more than typical. And second quarter, we're now quite a bit above the most inventory you'd expect. So there's definitely a surplus of inventory for Silicon Valley. Here's compared to the 10-year median. You can see that the 2018, early 2019 was a little bit higher. But again, look at the climb that we've been going through since New Year's. It's been pretty much a one-way up, and you can almost draw a straight line. Again, this thing here is Easter impact, and that's why I talk about every holiday negatively impacting real estate except Valentine's Day and Mother's Day. This now is looking at the number of offers accepted compared to typical. You can see that we were performing sort of typically. Your offers were coming up, and then they started to keep coming up, and they left the blue line, and they were getting to be healthy. We hit first quarter, basically, which is April 1st, and we did a little dip. And we're basically flat and going down. And that, that isn't a steep decline. So normally that wouldn't be alarming. But look at the climb rate that you normally have at this time of the year. Yes, you're about to the peak where you roll over and start coming down, but you're still on this climb part. So to be flat or going down slightly at a part when you're on the steep climb is why we're having such a change in the percentage. Here you can see that you're on the low side, but you're clearly not as low as we were in 2023. Basically, in 2022, we hit the peak pricing basically back here in first quarter sometime. The sales didn't get reported until, April, May. And then we went through the steepest decline in prices that I saw, and that's not on this graph in my career. And then basically people were unsure of what just happened. So you had low volume in early 2023, and we've never recovered that volume. So this is the low volume that we've had fairly consistently since the 2022 price correction. Here's your days unsold inventory. And again, it's the rate of climb. Well, there's two things. It's the rate of climb, which is a slowing of the marketplace, and also the distance above the blue line. So you're way slower than you'd expect to be, and you're climbing and you're slowing down quite a bit. If you look back, there are periods of time that had slower days unsold inventory, and this is just raw count. So this is my raw count. So there have been periods of time in almost every year where we were slower, just not at this year. And before the pandemic, we're basically at record territories at 51 days or something close to that. Here's days unsold inventory versus typical. Here again, you can see I'm going to have to blow out this chart. It's the same as the other one where you're basically right up here at the peak level, and I'm only, about 167%, and I only go to 170%. Here's your marketing time. Look how steeply this number has climbed. And remember, this is the bulk of the activity is in the low end, so that has lower numbers. the average number is probably climbing quicker than this 75th percentile. But look at the steepness since April 1st. You went from something like 15 days to sell all your 3/4 of your inventory, 3 out of 4 sellers, to 21 days. And this is an optimistic number because it only counts the sellers that were successful in selling. The DUI includes those that are trying to sell that aren't able to sell. Here's compared to typical. You come up here and you're not quite at record territories. That was back in early 2019 after the 2018 correction. And it was close in 2022, but I would say we're basically at the same level as in 2022 with that big, huge price correction. Here's what the sellers that are taking the largest price reductions, how large are their price reductions? And basically it's somewhere around 13%. You can see again the rapid decline since April 1st. Here's April 1st, you were only at about 91%, which is a 9% decrease, and now you're at a 13% decrease. That might not sound like a lot, but when you're talking about numbers around 12% being your high and you've had a 4% in the last month, that's significant. Here's compared to typical. The only time we had a larger price reductions was in that 2022 price correction. And again, I don't think I'll have to do it for next week, but fairly soon I'll have to change the scale on this, but mostly because this goes to 180% where the other ones went to 170%. Here's the seller's average ask price reduction to show that I'm not playing games. I just like that metric. The reason I don't like this metric, it's so tight. Basically, sellers for the most part do their homework before they put their house on the marketplace. So the vast majority of the sellers do know price reductions to get that offer in. It may not be the price they were expecting a month or 2 months or 3 months ago, but they still price their home accordingly. So you can see right now, the average price reduction is basically sitting at 1%. Here's compared to typical. So you've had periods of time when there were larger price reductions. This is the frequency of those price reductions. So how common are they? And right now you're about 14.25% of the sellers are doing price reductions. So what's that? About 1 in 7 of the sellers are doing price reductions. So 6 out of sellers are getting their offer in with no price reduction whatsoever. But typically you're way down here at about 7%. So you're almost double the number of sellers that are doing price reductions. Nothing to do with magnitude, just whether it's even $1,000 price reduction. Here now is compared to typical. So you're getting up to the point where you're in some of the areas of the most frequent price reductions. You had the period of time right after the 22 price correction and a period right after the 2018 market. And other than that, out of the last 10 years, this is sort of the highest number of sellers taking price reductions. This is the magnitude of overbidding. We're changed. Overbidding, I need sale price. Sale price doesn't come out until escrow's closed. That builds in an extra 4 to 6 week delay. But again, look at the decline, surprisingly, since April the 1st on the quarter change, and you're now down below the median price change, and you're going towards the cool. You're nowhere close to the cool yet, but that's the direction you're going. This slide, for those that are observant, I was researching it and I'm trying to resolve it. Here you look at it and you're some small fraction, I think it was like 0.6% above normal or 0.06%. And here you're below. So I don't understand why these two graphs aren't done. And my belief at the moment is it's probably because I'm using the 10 years, not including this year for my typical, and you're plotting it to this year. So I'm going to try to find the time to dig into that. It's the only graph that doesn't make sense to me at the moment. And the difference is pretty small, but basically based on this first chart, I'd expect the next chart to be below 100, be below 0. It's, clearly typicals up here at a number somewhere around 105%, and the actual some number around 104.5%. So you're roughly 0.5% less than you'd expect. This chart here says I'm dead on normal. So I don't understand that discrepancy at this given moment. Here's the frequency of the overbidding. You can see that you were more frequent overbidding. Basically, almost the last 2 years, you had more overbidding than normal, but we've changed around at the quarter. These are the quarter lines on April the 1st going into second quarter. We have come down and we're now below and taking less than the typical frequency of overbidding. So less frequent overbidding than normal. That's still 70% of sellers. So it's more than 7 out of 10 sellers are getting overbid. It's just you're normally up here at almost 3/4. And, that's not much of a difference, but it is a difference. The bigger difference actually is the rollover. The rollover occurred earlier than you were expecting. You weren't expecting the rollover here to happen until towards the end of second quarter, and right now it happened at the beginning of second quarter. Here you can see the mark change, which actually, when you do it on a percentage basis, it changed before the quarter change. This would have been about March the 1st, probably. And now you're coming straight down, and you can see you're somewhere around 95% of the typical frequently overbid. So less overbidding than normal. Here's my pricing. Pricing is still climbing. I think that number's about ready to roll over and come down. That's the only reason I haven't adjusted this appreciation for the last couple of years. And it depends on how you model it. You know, if you model it, we've had a 10.9%, that's the slower slope. It looked to me like a more accurate model was 12.5%, followed by a 3.3% increase. But it depends on what happens to this price range in the future, which we don't get into predictions. Now we're looking at distributions. Distributions are basically every transaction. In this particular case, I start at the median, and this is why median days on market is not a very good indicator. These numbers are very clustered together. You come out here to the 85th percentile, and that's the number I probably should have picked. I actually picked the 75th percentile back here, but you have quite a bit more separation than you do down in the median. The dotted line, which is what we're going to start off with, was a year ago. The purple line is the current data. So you clearly can see that the market is slower, taking longer time for the typical seller or any seller to sell their property. We start off jumping 1 week at a time, and then we go for 2 weeks, and let's get into it. You can see the market normally is slowing down at this time of the year because the dotted lines are increasing, just marching up. Now you get into a little bit of a level spot. And then after the Halloween, you start really climbing up. And then you get to New Year's and you really start accelerating down. Now, right there is the best we got this year. And then you start slowing down already. And now there's the current week again. So we've already turned the corner. We're already slowing down. So we've taken we've turned the corner, and it's taking longer and longer for sellers to sell their properties. And same thing, this is the largest. You go from the 2.5% of the sellers to the sellers that are, you ignore 2.5% because that gets rid of your data instability. We only go down to 17.5%, because even in the marketplace that I'm talking about right now, you can see that the sellers from 15% to 17.5% are doing no price reduction. So basically, that's just 85% of your sellers are doing no price reduction. So we go through and we start off on the dotted line up here. You can see that sellers are clearly taking larger price reductions this year than typical, or than they did, not typical, than last year. And we'll step through. You again can see that we're basically at the peak of the market last year because the pricing reductions started to increase week after week. Now you get to that summer doldrum type thing where you just bounce around a lot. And again, right around Thanksgiving, it starts dropping. I would say it already started dropping. There's sort of the bottom, and now it's racing up for New Year's. There's the peak of the marketplace this year right there. And now you've accelerated for the last 4, 5, 6, 7 weeks. So we've been taking larger and larger price reductions for the last 7 weeks. And this is overbidding. And again, I'll throw out the caution about this being a lagging indicator. You're starting off on the dotted line, which is a year ago. You're comparing it to the purple line. So again, we're taking less overbids than we did a year ago. The sale price was pretty much at the top, but you have a couple more weeks where you're up there before you decline. And then it's going to be interesting to see. And I believe that we're already going to be declining this year. So last year we had several more weeks, about 5 weeks before any significant decline. So now we're stepping through. There's sort of the hottest marketplace. Here's January, where you're accelerating rapidly. There's the peak of our market this year. Now you're starting to slow down right there. So we've only had 1 week. This is the second week of significant slowdown in the amount of overbidding. And again, there's a 4 to 6 week lag time in getting this information. Looking at active inventory in the 3 counties, I'm comparing San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. You can see Alameda County is getting back up to the record or the typical levels that it has at the end of second quarter, which is sort of the peak. So if we get up here, we're going to have sort of typical inventory pre-pandemic for Silicon Valley. Santa Clara County has been going up, but it's still slightly further behind than these blue lines back here early in 2016, sorry. And then San Mateo County actually looks like it's at or potentially slightly above its previous typical highs. Here's offers accepted. You can see that they're all down. Alameda County, that had more inventory, has less offers than Santa Clara County. So Santa Clara County is going to clearly have a higher turnover rate. And San Mateo County, that had sort of record high inventory, is not having record high offers accepted. Here's your days unsold inventory. You can see it's climbing. This is the turnover rate. And this is just actual raw numbers. So you can see that San Mateo and Santa Clara are right together here, basically at 44 days to sell out their existing inventory. Alameda County is significantly slower because it had fewer offers and more inventory. So both of those impact your days unsold inventory. So Alameda County is the slowest marketplace, and then San Mateo County and Santa Clara County are tied down here at 44 days. This is the marketing time. Alameda County has the longest marketing time. It's something like 25 days. Santa Clara County is second at like 19 days. And the fastest is San Mateo County at 17 days. And that's still fairly quick when you look at raw counts. For two of the major counties to sell 3/4 of the sellers to sell in 3 weeks, and the slow county to be doing it in under 4 weeks is still pretty quick pace. It's just Silicon Valley is typically on fire, basically, as far as the speed of the marketplace. Here's the price reductions. You can see all three are fairly close together. Alameda County is doing the most price reductions at about 1.1% price reductions for Alameda County, 1% price reduction, and about 0.95% price reductions for San Mateo County. Here's the frequency of the price reductions. You can see they're all increasing. They range from basically San Mateo County at about 13% up to about 16% of the sellers doing price reductions in Alameda County. Here's the average overbid. You can see it's rolled over and coming down. The average is now somewhere around 7% for San Mateo County and Santa Clara County. Alameda County, and this is bizarre, Alameda County is the slowest county. It had the most inventory and the least number of offers. It's got the highest overbidding. I think what's happening, and I don't have the data to support this, is sellers are taking price reductions. They're overstepping, because remember, these price reductions I'm talking about are small magnitude. Sellers come in and take a 5 or 10% price reduction. Then the buyers come in and overbid, because this overbidding is compared to the list price at the time the offer is accepted, not the seller's original list price. If I was following the seller's original list price, I would almost wager, but I'm not a betting man, that Alameda County would have had the largest price reductions. Here's the frequency of overbidding. So how common is overbidding? And again, this is in the rearview mirror, but all three of them are above 70%. They're very close together. I would say they're all between 70 and 73%. So just, 7 out of 10 to 3 out of 4 sellers are getting more than their ask price. And, in most parts of the country, real estate is something you negotiate downward, not upwards. Here now is the appreciation. This is from 2015. You can see Santa Clara County has the highest appreciation up here at almost 120% appreciation. The reason the graph's 200 is you have the original price plus 120. So it's only the 120 that's the appreciation. And then down below, you have Alameda County and San Mateo County very close together, about 81% appreciation. What makes real estate such a great long-term investment is most people are buying the house on leverage. So they're getting a loan, maybe a fixed rate loan, and they get the appreciation on the 80% loan or 90% loan that they're doing. Here's the sale price. You can see Santa Clara County and San Mateo County are very close together. Santa Clara County is still higher than San Mateo County, which is unusual, but it has happened before. And then Alameda County is the affordable county down here at around 1.350 or something like that. Here's the same information on regular paper. And I was right on the money. 1350 is the Alameda County. Here's estimated payments going through approximation. You can see payments have been fluctuating up and down, but fairly flat overall. They're not at the peak level that they were, which was basically somewhere in the second quarter of 2024 for all three counties. Here now are my micro market maps. This is looking at inventory. You can see inventory is blue everywhere except for Saratoga Los Gatos, which only has 83% of the inventory. So for whatever reason, Saratoga Los Gatos has a limited supply of inventory. This is the number of offers accepted. Saratoga Los Gatos is again sort of a bright spot at 100% of the offers you'd expect. The only area that's seeing a higher area is Los Altos and Palo Alto at 106%. So they're getting 6% more offers than they typically do right now. But again, if you go back to Los Altos and Palo Alto, it has 15% more inventory. So it's going to be a lower overall ratio. And then you come to the days unsold inventory compared to normal, and you can see that because Los Altos Palo Alto had more inventory and it also had more offers accepted, but a lower level of more offers accepted, their speed of the marketplace, the time to sell out their inventory is actually 18% longer than it normally is. So it's a little bit slower, but Saratoga's the reverse. It had more offers at 100% and less inventory. I forgot what the number was, maybe 85%. And so their time to sell out is 77%. Saratoga Los Gatos is the only area below 100. Los Altos Palo Alto is the second area above 100. Everybody else is around 150 to 250. So even though Saratoga Los Gatos is doing well, it's not on fire by any stretch of the imagination. Now I get rid of all the comparison and I just look at raw count. So if you come down and look at Saratoga Los Gatos, it's at 44 days. Los Altos Palo Alto is at 36 days. The fast day, if I can move the fast one is, I'm not seeing anything faster than 25 right now. So Cupertino Sunnyvale is the fastest at 26 days. The slow one is going to be probably down here at 100.3 days. Close on its heels are the expensive areas in San Mateo County at 99 days. Here's the marketing time for 3 out of 4 sellers. So if you look at this metric, and each metric I had assigned colors. So just because this is red doesn't mean this is a hot marketplace. It means that it's fast. It's what most people would perceive as being fast. You got Saratoga Los Gatos at 26 days. So even though it's doing better than normal, it's at 26 days, where Los Altos, Palo Alto was doing less well than Saratoga, but it's selling 3 out of 4 sellers in 2 weeks at 14 days. If you look up and down, most of these numbers are between 14 days and 3 weeks, which to me is very reasonable for 3 out of 4 sellers to sell. It's not sellers getting their offer in that first weekend, although still a significant number are doing that. 50% of the marketplace is probably selling in that first weekend, because this is the maximum time for the 3 out of 4 sellers. It's looking at how long it takes that 75th person to sell. This now is the seller's ask price adjustments. You can see they're fairly tight. Foster City's Redwood Shores, that I should ignore because it's so small, is at 0.2% increase. Redwood City's at 1/10 of an increase. Fremont, it doesn't have a single price increase. And you have to remember, this is average, so you could have someone raise it up 10% and someone lower it by 10%, and that would still be a 0. And price increases sometimes are actual price increases. I do catch a fair number of typo errors or data entry errors. I have a couple slip by, and that could explain the increase. I try to catch them all. But basically, these are fairly low numbers, so that's why it's a fairly white with a slight shade of pink and a slight shade of blue. Here's the frequency of price adjustments. You can see it's not very common. The least I'm seeing is Redwood City, which is a big geographical area at 4%. Saratoga Los Gatos, that he was doing well, is 23% of the sellers are doing price adjustments. Maybe that's why they're selling quickly. Los Altos, Palo Alto at 10%. This is the overbidding. This is lagging behind. So you got to add in that 4 to 6 weeks. Saratoga Los Gatos at 3% overbidding and Los Altos Palo Alto at 7%. So not large overbiddings in the more expensive areas in Santa Clara County. But overall, it was red in color. Buyer frequency of overbidding. How common is the buyer coming in with an overbidding? You can see you're basically from 2/3 to 3/4. You got some up here in Cupertino at 91% of the sellers getting more than their asking price. You got some high 70%. So I don't see any. Oh, here's some 80s in Foster City, Redwood City. Should ignore that. And also Pacifica Daly City at 81%. Here's the long-term appreciation. Very clear. The more affordable, longer commutes have done the best since 2015, most likely due to COVID and people being willing to commute in a little bit longer distances because they don't have to go into work as many days a week. Here's the price, and instead of following the median only, which is the middle number, I sandwich that with the lowest 10 percentile and the highest 90 percentile. So you have a sandwich. You know what price range to expect for single family homes in each one of your micro market areas. Here's a summary of the tables that we just went over. So you can start on the left-hand side and pick your micro market area, or on your right-hand side in your price range, and come back and look at the conditions you'd expect. What I find interesting is basically at a high level, the right side of the graph is basically red in color overall, which says that you're still a fast-moving marketplace. But the left-hand side, where we're comparing Silicon Valley to itself, we're much slower than we typically are. So even though we're much slower than we typically are, we're still fast. And that's sort of the contradiction. Here's the actual numbers of the offers accepted. The takeaways now is we're now the second slowest year out of the last 10 years. We're the second slowest out of the last 25 years. The years that were slower were 2020 because of the pandemic, and 2023. We are now accepting less offers than last year. Now, they're not a large number. I put my cheat notes here. 6 2 weeks ago, 10 last week, and this week we're 54 lower than we were last year. So we're selling less houses than we did last year. Here's the numbers for Santa Clara County, San Mateo County, and Alameda County, and Silicon Valley overall. You can pick the metric that you like the most interesting right off the bat. You can see that new listings is down a little bit, but overall inventory is up and sales are flat. That gives you a slightly slower DUI, which is an increasing number. So, market's slowing a little bit, it appears. We have been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties, 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in Silicon Valley in single agency transactions. Also available for consulting or understanding how this market data impacts you. Reach out in any way you'd like. I appreciate likes and subscriptions. It helps get the word out. Here's how you can get to the YouTube archive of my past presentation, the blue URL link, or you can type in the shorter green root URL that will take you to the same place. To join the Saturday morning presentations at 9 a.m., just type in the green root URL in the year 2025. Passcode is there if it asks for you. Handout is green root URL plus the letter H for handout, the year, month, and date code. So today's would be 2025-05-03 for Saturday's date. And any past specific episode you want to get to, you can pick the year, month, date after the green root URL and go there directly. Let's move on to the Greater Bay Area. Here are the 5 regions that we're going to be talking about. Silicon Valley, we've talked about at length already. The cities, San Francisco and Marin. The North Bay, the 4 counties. Central Valley is San Joaquin and Sacramento, the 2 big counties out there. And then the Central Coast is Santa Cruz and Monterey. Here is looking at the active inventory for all 5 regions. You can see all 5 regions are up steeply, and that's a growth in inventory, more selections. Nobody is at or even approaching their record high levels. Silicon Valley is probably the closest to approaching their typical, probably followed by the North Bay. Central Valley is lagging behind by quite a bit, and then the Central Coast and the cities are smaller and they're still lagging behind. I don't know which would be greater on a percentage basis. Here's the offers. Notice Silicon Valley and Central Coast. The number of offers has dropped off very, not noticeably, but definitely down since the first quarter. This is an indication of buyers are stopping to buy their activity. It is not impacting yet 3 regions, being the Central Valley, the North Bay, and the cities, San Francisco and Marin. So 2 regions out of the 5 have seen a decrease in the number of offers accepted, and those are the ones that are driven more by the high tech. I'm a little surprised that are the cities that's still up, with the Central Coast and Silicon Valley being down. Here's the days of unsold inventory for all the regions. High number here is a slower marketplace. You can see all 5 regions are increasing. You might argue that the North Bay and the Central Valley are flat. They're bouncing, that's for sure. They're not going down, and they typically go down in first quarter, and then they turn around sometime in the second quarter. So it's just a matter of how early in the second quarter they turn around. But now all 3 high-tech based regions are increasing, which is a slowing of the marketplace. Now it'd be Silicon Valley in the purple, the cities in the orange, and the Central Coast in the blue. Here's days on marketplace, and this is the time for 3 out of 4 sellers to sell their property in the different areas. Sort of a mixed bag here too, going up in Silicon Valley, going up in the Central Coast, bouncing around in the cities. It went up and then it came back down a little bit. North Bay had been increasing, but it did an improvement, and Central Valley has been going down, but appears to be flat for this past week. This might be impacted a little bit by Easter, but now we're 2 weeks past. You would think the data would be worked out. This is the ask price reductions. You can see that it's coming in the downward direction, which means larger price reductions, since the price reduction is a negative impact. So you have Central Coast down, you have North Bay down. Central Valley is basically looped up and bouncing and fairly flat, frankly. Cities is bouncing, but on a downward trend, and Silicon Valley is clearly down, going from earlier this year where you were above typical, but still small price reductions, to now taking a full % price reduction. Keep in mind, this is average, so the magnitude is pretty small here in the Central Coast, which is the most significant. That's only a 2% price reduction on average. This is the frequency of price, and this is important because if you go back to Central Coast, where they had a 2% average, but you only have 25% of your sellers taking any price reductions, that means 3 out of 4 sellers aren't participating, so that 2% becomes 8%. So sellers that are having to take a price reduction are having to take fairly significant price reductions on average, and that's fairly constant throughout the region. You can see Silicon Valley is up significantly. Central cities is up. You can see it pointing out right about there to the left of my cursor. You can see it plopping out a little bit to the right side of the purple line. And then you have gray and blue right on top of one another up here, and then the Central Valley up here being the most frequent price reduction, but it's still less than 30%. It's about 27% of the sellers doing price reductions. So 1 in 4 of the sellers are doing price reductions up in this range, and down here it's 14%, which is about 1 in 7 sellers are doing a price reduction. This is the amount of overbid. This is the average, so it includes those that go under asking as well as over. Cities has the most overbidding at about 9.5%, followed by the Silicon Valley at somewhere just under 7.5% overbid. Then the North Bay at somewhere around 2 1/3% overbid. And then the Central Valley right at 100%, so break even. And the cities that are just shy of 0.5% below their ask price. This is the frequency of overbidding. Most common overbidding is in the Silicon Valley area, but it's clearly rolled over. The cities is bouncing all over the place. You can see, and it's alternating basically. It's almost like can't make up its mind. It's a strong indication that even though I'm combining 2 counties, San Francisco and Marin, there's just not enough activity to stabilize your data. And it's important to have stable data in order to know if it's meaning or not. North Bay is rolled over. Central Valley is going up, so overbidding is still increasing and just over 40%, and Central Coast increasing overbidding, but just under 40%. Here's your long-term appreciation. The cities has got the least well appreciation at about 55% appreciation. It's bouncing again. North Bay is up here just shy of 70%. Central Coast is about 78%. Central Valley is at 90%. And the area with the highest amount of appreciation is Silicon Valley at about 102% appreciation. So here you have the sold price. You can see that the cities is below their 2022 peak. Silicon Valley is basically right at their peak of their 2022 pricing, a hair below their peak in 2024, but very close to their peak in 2024. Basically, it's at its peak in 2024 and at its peak in 2022. The Central Coast is clearly below its peak in 2022 and 2023 and 2024. The North Bay is currently just under its peak in 2024, peak in 2022, and peak in 2021, believe it or not. And then the Central Valley is basically right at, but just a hair below its peak in 2022 that crosses over. Silicon Valley is probably doing the best compared to their relative history and right at its previous peak. Here is now looking at the monthly payments. Go get a 30-year fixed at the national average, and you can do better than this. based on borrowing jumbo money, having a banking relationship with leftover money, those kinds of issues. By doing an adjustable loan, by putting more money down, this assumes an 80% loan, 30-year fixed at the national average of a high balance conforming loan published by the Federal Reserve Bank, and then using an estimate for property taxes and insurance. So total payment estimate using a 30-year fixed loan. Here are the actual numbers for the different areas. You can see what the current raw value is. You can see the change over a week ago, and then a change over 5 weeks ago in each one of the different metrics going across the top. And here again are the chapters. You can select the chapter that you find most interesting and jump right to it using the index chat in the YouTube description below. Not seeing any unmuted mic.